Hey there, folks. Welcome to another deep dive into the fascinating, albeit often terrifying, world of finance. John Oliver here, ready to delve into the wild world of financial crises. Buckle up, because this ride is going to be anything but smooth. Now, I know what you're thinking, John. Finance, that's even more boring than watching paint dry. And trust me, I get it. The mere mention of financial jargon can make anyone's eyes glaze over. And you'd be right, usually. But here's the thing. When the financial system goes haywire, it's like someone spiked the paint thinner with adrenaline. Suddenly, it's not just numbers on a screen, it's real people, real lives, and real chaos. When things go wrong in the financial system, it's like someone spiked the paint thinner with adrenaline. The calm, predictable world of finance transforms into a chaotic, unpredictable mess that affects everyone. We've seen a whole parade of financial freakouts in the 21st century alone. Each one unique in its own way, yet eerily similar in the devastation it causes. Remember the dot-com bubble bursting in the early 2000s? Yeah, good times. It was a period when tech companies were popping up like mushrooms after rain, only to collapse just as quickly. And who could forget the 2008 financial crisis, where the entire global economy almost went kaput because of some dodgy mortgages? It was a stark reminder of how interconnected our financial systems are, and how a problem in one area can ripple out to affect the entire world. Then, just when we thought we'd caught a break, bam, COVID-19 hit, sending shockwaves through the markets. The pandemic was a health crisis first and foremost, but it quickly morphed into a financial one, exposing vulnerabilities we didn't even know existed. It's enough to make you want to stash your cash under the mattress. The uncertainty can be overwhelming, making even the most rational among us consider extreme measures. But trust me, there's a better way. Financial literacy and smart planning can go a long way in protecting yourself from the worst of these crises. It's about understanding the risks and making informed decisions. These crises, while different in their specifics, share some common DNA. They often stem from a mix of greed, lack of oversight, and a failure to learn from past mistakes. By studying these patterns, we can start to see the warning signs before it's too late. And understanding that DNA is key to stopping history from repeating itself. Because let's face it, we're all tired of these financial roller coasters. It's about creating a more resilient financial system that can withstand shocks and protect the most vulnerable among us. Throughout history, financial crises have often led to significant changes in policy and regulation. Governments and institutions step in to stabilize the situation, but these measures are often reactive rather than proactive. The key is to shift from a reactive approach to a proactive one. This means not just putting out fires, but preventing them from starting in the first place. It involves rigorous oversight, transparent practices, and a commitment to ethical behavior in the financial sector. Education plays a crucial role in this. By empowering individuals with the knowledge they need to navigate the financial landscape, we can build a more informed and resilient society. Financial literacy should be a fundamental part of our education system, equipping people with the tools they need to make sound financial decisions. Looking ahead, technology and innovation offer new ways to enhance financial stability. From blockchain to AI, these advancements have the potential to create a more transparent and efficient financial system. But they also come with their own set of risks and challenges that need to be carefully managed. Ultimately, the goal is to create a financial system that works for everyone, not just the privileged few. It's about building a future where financial crises are the exception, not the rule. A future where everyone has the opportunity to thrive regardless of their background or circumstances. So let's take the lessons from past crises and use them to build a better, more resilient financial future. Because when we understand the unsettling rhythm of financial crises, we can start to change the tune. One of the recurring characters in our financial horror show is this thing called financial innovation. It's a term that gets thrown around a lot, often with a sense of excitement and promise, but what does it really mean? And more importantly, what are the implications for the average investor? Now, innovation itself isn't bad. In fact, it's the driving force behind much of the progress we see in the world today. From groundbreaking medical advancements to cutting-edge technology, innovation has the power to transform our lives for the better. I mean, I'm all for progress, whether it's self-driving cars that can reduce traffic accidents or a new flavor of ice cream that brings a smile to your face. These are innovations that add value to our lives in tangible ways. But on Wall Street, innovation often means finding new and creative ways to gamble with other people's money. It's not about creating something that benefits society. It's about generating profits, often at the expense of the unsuspecting public. You see, Wall Street loves a good invention, especially if it's complex and poorly understood. The more intricate the financial product, the easier it is to sell it as a must-have investment, even if the risks are sky high. Because complexity, my friends, is where the real money is made. When a financial product is so convoluted that even seasoned investors struggle to understand it, that's when the big players can make their move. They exploit the lack of transparency to their advantage. It's like a magician's trick. The more convoluted the illusion, the harder it is to see how you're being fleeced. The audience is dazzled by the spectacle, unaware of the sleight of hand that's taking place right before their eyes. And when these fancy new financial products blow up, and they often do, it's usually the little guy who gets burned. The average investor, the small business owner, the retiree who put their savings into what they thought was a safe bet. They're the ones left holding the bag. Meanwhile, the big banks and financial institutions, they often walk away with a slap on the wrist and a hefty bonus. The system is designed in such a way that the risks are socialized, but the profits are privatized. It's a win-win for the financial elite and a lose-lose for everyone else. It's enough to make you want to scream. The cycle of innovation, exploitation, and collapse seems never-ending. And yet, despite the repeated warnings and the lessons from past financial crises, the allure of new continues to captivate Wall Street. So the next time you hear about the latest financial innovation, take a moment to question who really stands to benefit and who might end up paying the price. Let's rewind to 2008, shall we? It was a year that would go down in history for all the wrong reasons. The financial world was on the brink of collapse and the ripple effects were felt across the globe. The year the music stopped, the party ended, and everyone realized they were playing a high-stakes game of financial musical chairs. With not enough chairs, the stock market plummeted, businesses shuttered, and the economy was in free fall. So, what happened? Well, it all started with these things called mortgage-backed securities. These financial products were supposed to be safe investments, but they were anything but. Sounds boring, right? That's what they were counting on. The complexity and jargon were meant to obscure the true risk involved. Basically, banks were giving out mortgages to anyone with a pulse, even if that pulse was barely there. It didn't matter if you had a stable job or a solid credit history. These weren't your grandma's mortgages, mind you. They were far riskier and far more complicated. These were adjustable rate, no money down ninja loans. That's no income, no job, no assets, in case you were wondering. They were designed to lure in as many borrowers as possible, regardless of their ability to repay. These toxic mortgages were then bundled together, given a shiny new name, and sold off to unsuspecting investors. It was a ticking time bomb waiting to explode. It was like turning a dumpster fire into a gourmet meal with some clever marketing. The true nature of these investments was hidden behind layers of financial engineering. But here's the kicker. Nobody bothered to check if these borrowers could actually pay back their loans. The entire system was built on a foundation of sand. And when the housing bubble burst, well, let's just say it wasn't pretty. Foreclosures skyrocketed, people lost their homes, and the financial system teetered on the edge of collapse. The aftermath was devastating. Financial institutions that were once considered too big to fail were suddenly on the brink of bankruptcy. The government had to step in with massive bailouts to prevent a total economic meltdown. The human cost was equally staggering. Unemployment rates soared, families were torn apart, and entire communities were left in ruins. The American dream had turned into a nightmare for millions. Experts and analysts scrambled to make sense of the chaos. How had things gone so wrong? The answers were complex, but one thing was clear: the financial system was in desperate need of reform. In the years that followed, new regulations were put in place to prevent a similar crisis from happening again. But the scars of 2008 would linger for a long time. Slowly but surely, the economy began to recover. People started to rebuild their lives, and the housing market eventually stabilized. But the lessons of 2008 would not be easily forgotten. Today, there's a greater emphasis on financial education and responsible lending practices. consumers are more informed and banks are more cautious. The hope is that we can avoid another disaster like 2008. So as we look back on the year the bottom fell out, let's remember the importance of vigilance and accountability in the financial world, because when it comes to our economy, we can't afford to play musical chairs with our future. Here's to a more stable and secure financial future for all of us. Let's learn from the past and build a better tomorrow. Fast forward to 2020 and the world is grappling with a different kind of crisis, COVID-19. Now, this wasn't a financial crisis in the traditional sense. It wasn't caused by reckless lending or exotic financial instruments. It was caused by a virus, for crying out loud. But here's the thing about our interconnected world. When one part of the system gets sick, the whole damn thing can catch a cold. Lockdowns and travel bans brought the global economy to a screeching halt. Businesses shut down, people lost their jobs, and the markets went haywire. Governments and central banks stepped in with massive stimulus packages, trying to keep the financial system afloat, and for the most part it worked. But the pandemic exposed the fragility of our system and the unequal impact of these shocks.